Morning, everybody. Welcome back to the Opportunistic Trader. It's just after 11 o'clock on November 27th, and we're joined by Joe Vaclavik of the Standard Grain. Joe's been joining us regularly to talk about ags and give us an update on the commodity world. How's it going, Joe?
I'm good, Michael. How you doing?
I'm great. I'm great. We've been talking a lot on the site this week. Thanksgiving was last week. Energy markets have been very active. And I guess the focus now for most markets this G20 meeting coming up, and wanted to get your thoughts on what you're hearing and or implications for the ag market based on it.
I don't know anything that isn't already known. I think that coming out of the meetings, the general consensus is that your best case scenario would be a ceasefire in regard to tariffs. That both Trump and Xi say that, all right, we're not going to put any new tariffs into place. We're not going to increase tariffs, and we're going to start to actually negotiate. I think that's probably your best case scenario. I don't believe that anybody thinks we're going to come out of the meeting and see tariffs on soybeans dropped immediately. I just don't think that's in the cards. Now, Trump is talking tough ahead of this thing. I mean, he said yesterday, everybody saw the article, he expects to raise tariffs on this $200 billion that's already being tariffed at 10% in early January. That's not fresh news. That's been the game plan all along. So this could just be posturing. It could just be positioning, ahead of the meeting. What actually happens, I have no idea. I don't know what Trump's end game is here. He tells us that he wants all these, he wants to close the trade gap, and he wants all these rules regarding technology and intellectual property changed. Is he going to settle for something in the middle? And I don't know what China's end game is. I mean, their economy's down in the dumps. They're really having a lot of problems. Does it matter? Some people think it does. Some people think it doesn't. I don't know. In regard to the soybean market, which is, as a grain trader, that's what we're watching here very closely. This is a bad deal. I mean, China, to go back into July when the tariffs were initiated, everyone thought that China by, September, October would have to come to the U.S. for beans, and that, even despite the tariffs, they'd still have to pay the 25% just because they'd run out. And that has not been the case. Everybody was wrong. China has gone through the month of October and now almost through the month of November without any significant purchases of beans from the U.S., which is really phenomenal. Everybody thought that this was impossible. They bought a lot from Brazil. They've done a lot to reduce their reliance on U.S. beans. They shifted their feed rations or the standards to include less soybean meal. And the other issue here is that Brazil started planting really early. They're going to harvest early. They're going to have beans ready for export come, say, mid-January. So it's looking like a bad deal for U.S. exporters. Even if you were to get a trade deal at this point, you're not going to make up the ground that you lost this year.
Yeah, so I guess that's the question though. Heading into year end with G20, I'm looking at actually March corn here and Jan beans. What's the trade, or is there a trade based on what we might or might not hear?
The funds are short. Managed money, large money managers are modestly short across the grain complex. We don't have, despite the low prices, we don't have an overly large net short position that we've seen the funds build up. In a lot of cases, if the funds were short 200,000 contracts of corn, I'd probably tell you, hey, there's a strong likelihood of a short covering event. But we just don't have that right now. We don't have a big enough short position in any of these markets, corn, soybeans, wheat, that I could tell you that we're going to see a big short covering event, or that it's possible. They just don't have that big of a short position to cover. Could you see a little bit of short covering ahead of year end, or following a trade deal later this week where maybe you make some progress? Yeah, you could see a little bit of it, but they don't have a massive short position despite the weak fundamentals and the low prices.
Yeah, it seems like now, especially corn, it's been in a relatively tight range for the past 3 or 4 months, and soybeans as well. We had a very big move at the beginning of the summer, and then we've kind of been in a wait and see mode. And you just said that the position is light short on both of those. Was it long? What was the position kind of at the beginning of the year? What was the mindset of ags to start 2018?
We had a lot more positivity. I mean, there was a long stretch of time where the soybean market was north of $10. The corn market has been a little bit more range bound even than the bean market. I mean, since the middle of, say, 2014, Corn market's been confined to a range. Spot month futures, I'm talking from 301 up to 439, I believe, and that's a really tight range when you consider what we've seen over the last 10 to 15 years. I mean, we saw an $8 corn market in 2012, and now we're confined to this tight little range from $3 up to 440. And really, we've spent the majority of our time in a range even tighter than that. A lot of 350 up to 380 or 350 up to 390 in nearby futures. So the volatility has really died down here the last few years. We've seen more volatility in the soybean market. I mean, like I said, we had November beans for this fall, November 18 delivery, which they're off the board now, but they were up to $10.60 and even stayed there after for a while after the tariffs went into place. And it was really several weeks after the tariffs went into place that we saw the big collapse. So, I mean, we've seen volatility this year. I'd say the markets are probably toward the lower ends of what we're going to see here. But if we don't get a trade deal, the beans are a wild card. I mean, we could still be overpriced, but I don't know what's going to come out of this.
Yeah. Well, that's the big question. And so I guess the question is, what have we learned also, though, based on the move in soybeans that we can apply to future years? It seems like the market, like you said, was slightly supportive, and then the trade spat kind of caught the market off guard, and we saw a move in beans from $11 to $9 pretty swiftly.
Well, I would say that most people who follow the fundamentals of the market, as I do, would probably have told you even before the trade war started that the fundamentals were kind of shaky. We've been expanding acreage here in the U.S. for years. Our production has just expanded at a really phenomenal rate over the last 5 or 6 years. So I mean, the fact that China hasn't bought beans has been a big problem. But the other big problem is overproduction. And I think that even prior to the trade dispute, a lot of analysts would have told you exactly that. And there were a lot of people who thought that, $10 beans for fall delivery this year were overpriced, earlier in the year based on just the production expectations. So it's not what's happened in the market isn't shocking to me. I mean, the trade war, I think, caught everybody off guard to some extent. The fact that it's gone on this long has caught people off guard, maybe to some extent. But I don't know that anybody who follows the soybean market is shocked that we're closer to $8 or $9 than we are 10 or 11 at this point in time.
Yeah. But are farmers profitable where we are right now?
No, no. December corn futures at 357 is bad news. January soybeans at 872. Those prices don't make money. I mean, for this 2018 crop, which has just been harvested, or they're just wrapping up harvest, these are not profitable levels. Now, farmers were given opportunities to sell or forward contract grain at profitable levels earlier this year. We had December corn up into the 420s, I believe. We had these November, January soybeans well above $10. Those were profitable levels. What we've seen now is we went through the growing season without a crop problem. We ended up with very big crops, and now you've got low prices in the fall. That's pretty normal. That's a normal occurrence. I think that the trade dispute has made things worse.
Absolutely. It's interesting. As I asked that question, and you said no right away. I'm just thinking in my head here. We've been talking some Bitcoin on the site. Bitcoin miners not making money right now. With this recent oil decline, we're hearing some different shale people that aren't making money at this current level, and you're talking about some farmers as well. So margins are very tight everywhere.
Yeah, that's kind of funny that you mentioned that, because I do follow the cryptocurrency market just a little bit. And I've read just on the news this morning, I mean, half a dozen times they must have mentioned the fact that we're so far below the cost of production, and some had argued that that's a reason to be long the market. I mean, I think that's the word, being a grain trader, that's the worst reason I've ever heard to be long the market, because this soybean market or corn market, they don't care about the farmer's cost of production. I mean, they really don't at all. We could stay below the cost of production for years. It's based on supply and demand, and as long as the farmer continues to supply the market, you could remain at prices below the cost of production for a long time. I mean, what you really need to happen is you need low prices to deter production, which is in farming in the United States is very, very difficult to do, because farmers have so much invested in overhead that they can't afford to not plant a crop. And they're not going to stop planting because the prices are low. They've got to plant a crop because they've got so much invested in land, in machinery. They can't afford to go idle or pull any acreage out of rotation that they own. I mean, they could reduce some of the production on their rented ground, but another farmer is just going to swoop it up. So it's kind of an interesting deal that maybe you don't see in other industries. There's so much overhead, and so it's such a high stakes game. They can't afford to not plant a crop, and that's part of the problem we've seen here the last few years.
Yeah, I agree with you as well. Also on that first comment about how they're talking about, hey, since it's the cost to, the price should be around where cost is, and that's just not the way the world works.
Well, in other markets, it could. I mean, in Bitcoin, you might see the mining stop because it's too cheap, but it'll pick up again once it becomes profitable, or if it becomes profitable. In grains, it's just not that way. You can't turn off production on a dime.
Yeah. So what are you looking at here? What's piquing your interest in really any market that you might be taking a look at?
I mean, this for anybody. I mean, I think anybody who's watching any market is very interested in this China thing. It's affected everything from the grains to the stock market to the currencies. I think that this is the biggest thing we've got going on in financial markets right now. Overall economy appears to be very good to me. I think the stock market is doing something different than the economy is doing. Stock market's in the midst of a correction, which happens in bull markets. Markets don't go straight up forever. So I'm kind of still viewing that as a correction. The grain markets, unfortunately, are just, I mean, that's my bread and butter. And it's just unfortunately been very slow. There's been not a whole lot of opportunity for the producers. Even some of the end users are being squeezed here. You would think that with corn as cheap as it is, that ethanol production would be really profitable, and it's not. Ethanol producers are near break even. Some of them have negative margins. Ethanol prices are the lowest since 2005 or 2006. That was around the time that ethanol started to get big in this country. They put the mandate into place in 2008. So even with cheap corn prices, ethanol is not really profitable here at all. We've seen some facilities idled and shut down, and that represents a big portion of the demand base for corn. So you've got some negative headwinds here, definitely.
Yeah, for sure, for sure. What about for the week? Right now, most of the other markets are a bit on the quieter side. Is everybody in kind of wait and see mode for G20?
I think we're in wait and see mode. I would probably, if I had to pick positions here, I would probably steer clear of anything in the soybean market. I think there's just too much riding on this meeting and too much volatility that you could be exposed to. Big picture, I'd probably tell you I like the long side of the corn market. If you have the ability to hold the position for an extended period of time, like December 19 corn at $3.92, I would venture to say that you'll see the market up to 410 or 420 at some point in time, whether it be during the next couple of months, or maybe you have to wait till spring or summer. But I'd venture to say that you see that. That's the pattern that we've seen the last 4 or 5 years. It has repeated itself. I don't see this year as being any different. The wheat market's kind of interesting. Wheat is one of the only one in the grain markets that's actually priced higher than it was a year ago, by pretty significant margin. And U.S. export business has been very soft, but a lot of people expect it to increase. We've got that naval conflict in Russia with the Ukraine, and both of those countries are big exporters of wheat. Russia in particular is the biggest. So we got to keep an eye on that situation. If it were to limit exports out of the Black Sea region to some extent, that could be a friendly factor for the wheat.
Yeah, that'll be interesting. Wheat has actually been a pretty interesting mover all year. Right now, trading just below $5, but we had that run up to 620 or so, then a quick move back down to this 5 area. So that's another one interesting to pay attention to.
Yeah, we tend to see some volatility there. I mean, the wheat market isn't like the corn where it just sits still for months on end. It moves, and maybe it's just a market that's a little bit more thinly traded. Maybe it's a market that the funds can push around a little bit more easily. But you get some volatility there, and it's been a good thing for our wheat producers. We've at least had opportunities there. I mean, as recently as just a couple of months ago, you had opportunities to price wheat for both this year and for next year, and we just haven't seen much of that recently at all in corn and soybeans.
Yeah, absolutely. All right. Well, hey, thanks a lot for the ag update. A lot to look forward to. We'll definitely have you back after G20 once we've had some time to digest it, markets as well, and get some updated thoughts. But Joe Vaclavik of Standard Grain, I really appreciate it. We'll talk to you soon.
Sounds good. We'll see you later.